Hi, I'm Tom Jarck, Vice President, Proprietary Product Development with the MIAX Exchange Group. I have a long history of derivatives trading, both as a floor market maker in Chicago and on institutional trading desks at several of the large Wall Street banks in the New York area. The VSpikes index is a volatility measure of expected 30-day volatility in the Spikes volatility index. VSpikes is constructed using the well-known variance swap methodology, where it can be replicated by that static portfolio of spike options. But there's one major difference than some of the other vol indices use. The difference is that VSpikes applies that simple variance swap methodology where weighting of each strike is equal rather than inversely proportional to the strike, which is the traditional method. In volatility options such as spikes, the upside strikes, out of money calls, will tend to have higher volatilities associated with them than the lower strikes. So the standard variance swap methodology, where you're using that inverse proportional weighting, gives too much weight to those downside strikes and too little to the upside strikes. VSpikes corrects for this with the simple variance swap methodology, where we weight all the strikes equally. The ticker for VSpikes is VSPKE, and it's available through Opera data feed. So if you're getting US option prices, your vendor should have access to the VSpike index. The one thing to note today, last night, December 15th, the VSpikes index level was 154.80, which is off from the recent closing high of 206 earlier this month. In November, the average was roughly 145. And just to note, though, that the index began disseminating October of 21. So the historical information only goes back to that date. For more information, please reach out to me, TJARCK at MIAXoptions.com, or you can go to the website, MIAXoptions.com/spikes, where you'll find information on VSpikes and spikes and other products. Hi, I'm Tom Jarck, Vice President, Proprietary Product Development with the MIAX Exchange Group. I have a long history of derivatives trading, both as a floor market maker in Chicago and on institutional trading desks at several of the large Wall Street banks in the New York area. I'm joining you today to provide a quick summary of the Spikes Volatility Index for the options term of the week. Spikes is an equity volatility index that measures 30-day volatility of the popular SPY ETF. The SPY ETF, as you know, is an exchange-traded fund that tracks the price and yield performance of the S&P 500 index. The index level and settlement value for spikes are priced from options on this SPY ETF. SPY options trade on multiple options exchanges. SPY options offer tight bid-offer spreads, which is important to us in our calculation. The calculation incorporates a proprietary price dragging methodology, and this helps to avoid any erratic jumps in the index level. The index value is published over Opera, and it's published every 100 milliseconds. So those that are that use a volatility index for a signal or some kind of indicator, you'll find the Spikes index very consistent, stable, and timely. Spikes options trade on MIAX, and the Spikes Index Futures trade on the Minneapolis Grain Exchange, known as MGEX. Both products have monthly expirations and expire in unison with one another. The expiry is 30 days prior to the next SPY ETF options monthly expiration. Spike is the options symbol, SPIKE, and SPK is the official futures symbol. But please note, many vendors, data vendors, use their own unique symbology or tickers for their products, for futures products. Spikes products can be a diversifier in your portfolio. What I mean by that is it can give you another access point to implied volatility of the S&P 500 through the SPY ETF. And this can help eliminate, a risk of a single point of failure. In more typical volatility regimes, the Spikes index will move inversely to the SPY ETF. Many look, because of this fact, many look to use it as a hedging instrument, while others with exposure to long volatility might look to, implement strategies that would profit from a declining volatility. December 15th, the Spikes Volatility Index closed at 1787, and it remains quite elevated still from the low levels we saw prior to the February 2020 and the pandemic. Those levels were back in the low teens prior to that time. We clearly remain in a higher vol regime at this point. Thank you, and I look forward to future discussions on the topic of volatility. And for more information, you can reach out to me directly at tjarck@miaxoptions.com, or you can go to our website just for general information, miaxoptions.com/spikes.
I'm Kevin Davitt. I'm an instructor in Cboe's Options Institute, and this is the spread term of the week. By definition, vega is an options risk sensitivity measure that describes how much an option price is expected to change for each 1% change in the implied volatility for the underlying asset. Let's take a closer look at how vega behaves by comparing different options. Now, for example, a longer dated option will have a higher vega or sensitivity to changes in implied volatility when compared to a shorter dated option with the same strike and underlying. The reason for that is relatively simple. An option with more time until expiration has more opportunity to eventually move in the money. Now, at the money options typically have higher vega sensitivities when compared to in the money or out of the money options. So an example there, if equity XYZ is trading for $50 and the implied volatility is 35% across maturities, then the at the money 50 strike call that expires in 30 days would be worth just over $2 and would have a vega of about 5.7 cents. If we change the maturity from 30 days to 120 days, we notice that the longer dated option has both a higher price and a higher value for vega. If the implied volatility for this underlying moved from 35% to 36% across maturities, the option expiring in 30 days would likely increase in value by about 5.7 cents. By comparison, the call with the same strike that expires in 120 days would gain 11.42 cents in value. Changes in implied volatility assumptions impact calls and puts in the same direction. If implied volatility assumptions increase, the value of both calls and puts increase. Now, conversely, if implied volatility assumptions decrease, the theoretical value for both calls and puts decrease. So options with the same strike and expiry have the same vega exposure. So to summarize, vega is a way to measure the expected change in the value of an option for every 1% change in implied volatility for the underlying. I'm Kevin Davitt. I'm an instructor in Cboe's Options Institute, and this is the spread term of the week. So we hear this often. Options are financial instruments that convey the right, but not the obligation to purchase or sell the underlying at a specific price on or before a specific date in the future, and that's absolutely true. But there are a few key differences between index and equity or ETF options. Now, for one, equity options convey the rights to the underlying stock, and they settle to physical stock. So for example, Microsoft options will settle into Microsoft stock. Index options have a few distinct differences because the underlying is an index. So let's understand them. Now keep in mind that an index is a measurement tool, and it's not a tradable product. So as a result, all index options settle to cash based on the index value at expiration. Now, it's also worth highlighting the style differences between index and equity options. Nearly all index options are European styled, whereas all equity and ETF options are American styled. Be aware that European styled options can only be assigned on their expiration date, whereas American style options can be assigned at any point on or before the option's expiry. Now, the final point, which is an important one for many option users, is that there are different tax considerations for index options versus equity or ETF options. Section 1256 of the IRS tax code created a specific, potentially beneficial tax treatment for index options, which is generally not the case for equity or ETF options. So, those are the key differences between index and equity options.